Sheng Siong just posted another steady year, strong margins, rock-solid balance sheet, and consistent earnings. But with a 22.8 times price to earning and 5.5 times price to book, is it too expensive for a supermarket chain? Or is this still a safe haven stock in a volatile market? Let's break it down. Quick disclaimer, this video is for educational and informational purposes only. It does not constitute financial advice. Please do your own research or consult a licensed advisor before investing. Sheng Siong operates a wide network of over 70 stores across Singapore, offering a carefully curated mix of fresh produce, daily essentials, and value-driven house brand products. As a trusted household name, its no-frills, high-efficiency operating model is tailored to Singapore's cost-conscious consumers. While it may not deliver explosive growth, Sheng Siong thrives in times of economic uncertainty, offering defensive stability, consistent earnings, and affordability that resonates deeply with everyday shoppers. Sheng Siong kicked off 2025 with another solid quarter. Revenue rose 7.1% year-on-year to 403 million Singapore dollars, thanks to festive Hari Raya demand and 8 new stores opened across 2024 and Q1 2025. Net profit climbed 6.1% to 38.5 million Singapore dollars, as gross margins improved to 30.3% on stronger sales mix. But expenses are rising, with selling and distribution up 13.3% and admin costs up 8.8%, driven by higher staffing and lease costs. Meanwhile, China remains a small contributor at just 2.8% of revenue and is still loss-making. Operating cash flow slipped to 27.9 million Singapore dollars from 37.9 million Singapore dollars, due to seasonal digital payments and vendor payouts. Still, cash reserves grew to nearly 367 million Singapore dollars, and the balance sheet remains strong with reduced liabilities. Looking ahead, Sheng Siong is expanding into new locations like Kinex and Cathay, while bracing for inflation, manpower shortages, and geopolitical risks. Despite tighter margins, the group's focus on affordable essentials, operational efficiency, and prudent growth keeps it a steady defensive bet on SGX. Here's a breakdown of Sheng Siong's Q1 FY 2025 revenue growth by segment. As shown in the chart, the lion's share of the 7.1% year-on-year revenue growth came from new store openings in Singapore, contributing a solid 6.3 percentage points. These include 2 stores launched in Q1 2025 and 6 from the previous year. Meanwhile, same-store sales in Singapore added just 0.1%, suggesting that mature locations are nearing saturation with limited organic growth. China operations contributed 0.7%, but they remain a small part of the business, making up just 2.8% of total revenue, and continue to be loss-making due to high operating costs. Overall, Sheng Siong's revenue expansion remains store-driven, with growth highly reliant on physical footprint expansion rather than increased sales per store. Let's take a look at Sheng Siong's financial performance over the past 3 years. Revenue has grown modestly from 1.38 billion Singapore dollars in FY 2022 to 1.43 billion Singapore dollars in FY 2024, driven primarily by new store openings and resilient demand for essential goods. Net profit rose from 133.1 million Singapore dollars to 137.5 million Singapore dollars, supported by operational efficiency and tight cost control. EBITDA has shown consistent growth, hitting 235.5 million Singapore dollars in FY 2024, reflecting solid cash-generating ability. Profitability metrics remain strong, with profit margins around 9.6%, return on equity above 25%, and return on assets above 10%, showcasing the company's capital efficiency. Earnings per share has steadily increased, from 8.78 cents to 9.15 cents, and the dividend per share has grown to 6.4 cents, rewarding shareholders with consistent income. Free cash flow remains healthy at 155.9 million Singapore dollars, and Sheng Siong holds a strong cash position of 366.9 million Singapore dollars. With a conservative debt-to-equity ratio of just 20%, Sheng Siong has one of the cleanest balance sheets among SGX-listed consumer stocks. In summary, Sheng Siong continues to prove itself as a reliable, defensive play with steady growth, high returns, and excellent cash discipline, ideal for investors seeking stability and yield. Here's how Sheng Siong has performed financially over the past 5 years. Starting with revenue, the group grew steadily from 1.39 billion Singapore dollars in 2020 to 1.46 billion Singapore dollar today, showing consistent strength in essential retail. Net profit has remained healthy and stable, hovering between 133 million Singapore dollars to 140 million Singapore dollars, demonstrating efficient operations and disciplined cost control even in a low-margin sector. On the EBITDA front, the business improved from 228 million Singapore dollars in 2020 to over 235 million Singapore dollars in 2024, confirming strong underlying profitability and cash generation. While the share price held steady around 1 Singapore dollar and 55 cents for several years, it has surged recently to over 2 Singapore dollars and 8 cents, reflecting growing investor confidence and Sheng Siong's solid fundamentals in an inflationary environment. In short, Sheng Siong may not be a high-growth rocket, but it's a rock-solid, cash-generating machine that shines when markets get turbulent. Let's break down the key opportunities and risks for Sheng Siong investors. On the upside, Sheng Siong benefits from steady demand for essential goods, giving it a strong defensive edge, especially during economic uncertainty. With over 70 stores and new ones opening each year, there's still room for local expansion, particularly in underserved neighborhoods. The company's fortress balance sheet is another plus, with over 366 million Singapore dollars in cash and minimal debt. It can weather downturns without financial strain. Add to that a consistent return on equity above 25%, reliable dividends, and strong free cash flow, Sheng Siong is a cash-generating machine. But there are risks too. The stock currently trades at a high valuation, with a PE of nearly 23 times and a PB of 5.56 times, which could limit future upside. Growth is also slowing, same-store sales are nearly flat, meaning future expansion hinges on new store openings. While it's expanding into China, that segment is still loss-making. Rising labor costs in Singapore and intense competition in the grocery space also squeeze margins. In short, Sheng Siong offers rock-solid stability and income, but investors should weigh that against its premium valuation and slower growth trajectory. Let's review what the analysts are saying on Sheng Siong, OVA.SI. DBS Research and Maybank set the most optimistic targets at 2 Singapore dollars and 30 cents, implying approximate an 8 to 9% upside from today's 2 Singapore dollars and 12 cents share price. DBS justified this on the back of Sheng Siong's stable earnings and margin strength. OCBC Investment takes a more conservative view, with a target of 1 Singapore dollar and 99 cents, suggesting a 6% downside. It sees solid fundamentals but notes valuation near peak. UOB Kay Hian is aligned at 1 Singapore dollar and 97 cents, implying a 7% potential dip, reflecting cautious leasing and margin reviews. Phillip Securities is the most reserved among current analysts, assigning an accumulate rating and a 1 Singapore dollar and 89 cents target, 11% downside, citing sector headwinds and limited growth traction. Overall consensus among 710 analysts is a buy, with an average target price around $2.12, $2.13, suggesting essentially sideways movement from current levels. In summary, optimists expect up to 9% upside, while cautioners see up to 11% downside. The market appears fairly priced at current levels, with earnings stability priced in, and limited re-rating potential unless margins or same-store sales accelerate more sharply. Sheng Siong stands out as a steady, defensive stock in uncertain times. With strong margins, a solid balance sheet, and consistent dividends, it delivers reliable returns. While growth is modest and valuation is high, at a 22.8 times, PB 5.6 times, investors are paying for stability and efficiency. Verdict: a great pick for income-focused investors. For growth seekers, wait for a better entry point or signs of overseas traction. Do you own Sheng Siong, or are you waiting for a pullback? Drop your thoughts below, and don't forget to like, comment, and subscribe for more SGX stock deep dives, only on Durian Finance.